Okay, let's unpack this immediately. Because if you have been glued to your screens for the last 12 hours, you are probably exhausted.
I think that's an understatement.
The last 24 hours have been absolutely relentless. I mean, we aren't just seeing volatility, we are seeing a structural shift. Bitcoin has breached that psychological $75,000 fortress.
Yeah, we touched a low of $74,876. The panic in the air, it feels thicker than it has in months.
It's a brutal morning, and I think for a lot of people tuning in, the instinct is to try and find the reason in the headlines they already saw.
Right. They're thinking about the hyperunit whale liquidation from Friday, or maybe just the, general anxiety about the government shutdown.
But if you are trading on that information, you are trading on ghosts.
Exactly. The narrative didn't just evolve overnight. It changed species.
That's the critical piece here. I feel like we need to just clear the board. We aren't talking about a crypto-native leverage flush anymore. This wasn't some DeFi protocol hack or, a whale getting liquidated on a lazy Sunday.
Not at all. The catalyst for today's drop came from completely outside the ecosystem.
It's a liquidity contagion event.
Precisely.
Yeah.
And to understand why Bitcoin is trading below $75,000 right now, you don't need to look at the blockchain. You need to look at the Asian equity markets.
Specifically, a crash in South Korea, a crash so severe it triggered a sidecar trading halt.
A sidecar halt.
Yeah.
Now, that is a term that sounds, I don't know, mechanical, maybe even benign. But in trading terms, it is anything but.
Not a term we hear every day. So our mission for this deep dive is to be clinical. We are going to do a forensic analysis of this systemic fracture that started in Asia. We need to look at Strategy Inc., formerly MicroStrategy, and their, frankly, dangerous new position now that the price has dropped. And we have to talk about the political escalation in Washington.
The one that's threatening to extend this fiscal paralysis. It's a complex picture with a lot of moving parts, so let's just strip away the noise.
Let's focus on the mechanics. And let's start with that macro contagion. Take us to Seoul. What exactly happened at 11:31 a.m. Korea Standard Time on February 2nd?
Okay, so a sidecar is essentially a circuit breaker for program trading.
For the algos.
For the algos. It's a mechanism the Korea Exchange, the KRX, uses to prevent them from just spiraling out of control. If futures contracts fluctuate by more than 5% in under a minute, the exchange automatically halts program trading for 5 minutes.
It's like pulling the plug to let things cool down.
That's a good way to put it. It's an emergency brake. But for that to trigger, the selling pressure has to be just overwhelming.
And it was. The KOSPI index closed down, 5.26%?
5.26%.
Yeah.
To put that in perspective, that is the worst single day they have had since last November. This wasn't a drift lower. It was a cliff edge.
And when you see an index like the KOSPI drop that hard, you have to look at the heavyweights. The KOSPI is basically a proxy for the global tech sector, right?
It is entirely tech-dominated. And this is where the AI trade collapse really comes into focus. We saw Samsung Electronics fall 6.3%. SK Hynix, another massive semiconductor player, fell 8.7%.
These are mega cap companies. For them to move 6 or 8% in a single session is like an elephant trying to sprint.
It causes a lot of damage.
So what pulled the rug? Was it earnings? Did someone miss a revenue target?
No, and that's what makes this so fragile. It was a reality check. There was a rumor circulating that NVIDIA was about to commit $100 billion to OpenAI.
$100 billion.
And that rumor had been propping up valuations all across the supply chain.
That number is just staggering. It sounds too good to be true.
And it was. NVIDIA's CEO Jensen Huang came out and clarified the situation. He stated, and this is a quote, that this was never a commitment, just a possibility under review.
Ouch. So the rumor mill stops, the bubble bursts, and everyone rushes for the exit at the same time. But I want to bridge the gap here because this is where people get lost. How does a comment about OpenAI tank Bitcoin overnight?
Right. Bitcoin isn't a semiconductor company.
Exactly.
It comes down to the liquidity valve mechanism. You have to remember who the marginal buyer and seller is in these markets. South Korean retail investors are highly leveraged.
Some of the most aggressive traders in the world.
For sure. And they have significant overlap between tech equities and crypto. So the same trader who is long Samsung and SK Hynix on margin is also holding Bitcoin.
Okay, see. So when Samsung and SK Hynix crater, the margin calls come in immediately.
Instantly. You have to post cash to cover your losses. And if you don't have cash, you have to sell something. And unlike the stock market, which has closing hours, Bitcoin is 24/7.
Bitcoin became the ATM.
Bitcoin became the ATM. Traders sold what was liquid BTC to cover losses in what was crashing.
So it's not that they lost faith in Bitcoin specifically. It's that Bitcoin was the only thing they could sell at 3 in the morning to save their stock portfolio.
And that explains the correlation spike. We always talk about Bitcoin as a non-correlated asset, a hedge. But in a moment of acute stress like this, the correlation goes to 1. It lost its defensive utility overnight.
It just traded in lockstep with high beta semiconductors.
The risky stuff, yeah. And frankly, the timing could not have been worse. This all hit during the weekend gap.
That's a crucial point. Sunday night in the U.S., the big institutional desks, the ETF bidders like BlackRock and Fidelity, they're all offline.
They're gone. There is no backstop. So when this selling pressure wave hit from Asia, there was no institutional wall of money there to absorb it. The market was thin, it was vulnerable, and the price just wicked down.
So that's the anatomy of the crash. It's systemic, it's global, and it's driven by a desperate need for cash. Now, I want to pivot to our what's new versus what we knew segment, because if you just read the headlines from Friday, you might think the corporate situation is stable. But we have some new data on Strategy Inc. that is, well, a little alarming.
The landscape has changed dramatically for them in just the last 12 hours.
Let's start with that big one, corporate treasury, Strategy Inc., formerly MicroStrategy. What we knew is that they buy Bitcoin aggressively. That's their DNA. But what's new today?
They filed an 8K with the SEC this morning. They confirmed the purchase of another 855 Bitcoin for $75.3 million.
Okay, so what was the average price?
They paid an average price of roughly $87,974 per coin.
$87,000, and we're trading at 74 and change. That is a steep premium. They're immediately taking a loss on that specific buy.
It's about a 15% immediate haircut on that tranche. But here is the critical delta, the thing that is completely new as of this morning. For the first time in this cycle, Strategy Inc.'s aggregate cost basis is underwater.
Wait, their entire position, not just the new buys.
Their entire position. They hold over 712,000 Bitcoin. Their average cost basis across that entire stack is $76,037, with the spot price dipping below $75,000.
They're sitting on an unrealized loss on a $53 billion position.
Exactly. It's heavy.
Psychologically, that has to change the game. We saw Michael Saylor tweet more orange yesterday. Usually the market takes that as a victory lap.
Today, it isn't being read that way. It's being interpreted as defensive reassurance. Because you have to look at how they're funding this. They're using at-the-market equity offerings.
Break that down. They aren't using cash from operations.
No. They are selling MSTR stock to the public to raise cash to buy Bitcoin. And when the Bitcoin price is below their cost basis, they are effectively diluting their shareholders to buy an asset that is currently losing value.
They're introducing equity risk into the equation.
Significant equity risk. If you are a shareholder, you are getting diluted, and the book value of the assets you own is dropping at the same time.
That sounds like a recipe for a revolt.
It creates a dangerous feedback loop. I mean, if equity investors start to panic and sell the stock because of this dilution, it becomes harder for them to raise cash to buy more Bitcoin. If they stop buying.
Who supports the price? We are now watching for a decoupling of the stock price from the Bitcoin price.
And that would be a huge leading indicator of further downside.
That's a massive shift. The infinite money glitch of selling stock to buy Bitcoin might be breaking. Okay, let's move to topic B, U.S. fiscal policy.
This is the other shoe dropping.
Right. What we knew was the government is in a partial shutdown. We knew Speaker Johnson planned to vote for Tuesday. We thought there was a path forward. But something happened Sunday afternoon.
This is where it gets ugly, and we need to be very precise here. We had a leak. ProPublica published the identities of the federal agents involved in the Alex Pretty shooting.
Jesus Ochoa and Raimundo Gutierrez.
Yes. This is the doxing incident. And regardless of the politics of the leak itself, the consequence for the market is what we care about.
How does a leak about agents in Minneapolis affect a budget vote in D.C.?
It has hardened the House Freedom Caucus. They see this as an institutional attack on law enforcement. No. In a letter they sent, they made it clear they will not allow Democrats to strip DHS funding now.
So any room for negotiation just evaporated.
Completely. And here's why the mechanics matter so much. Speaker Johnson's plan was to use a procedure called suspension of the rules to pass a funding bill on Tuesday.
Suspension of the rules? That sounds like a shortcut.
It is, but it requires a 2/3 majority to pass. You need Democrats. But Democrats can't vote for DHS funding without reforms because their base is furious about the shooting. And now Republicans can't vote for reforms because their base is furious about the leak.
The legislative trap is sprung. Johnson needs a miracle to get two-thirds of the House to agree on anything right now.
Mathematically, it is highly, highly unlikely to succeed. The market was pricing in a resolution by Tuesday. Now we have to price in a shutdown that extends indefinitely.
And that brings us to what you call epistemic risk.
It means we don't know what we don't know. In a prolonged shutdown, federal economic data stops. No jobs reports, no inflation data. The Fed is flying blind.
Investors hate uncertainty, and we just got a massive dose of it. The data feeds are going dark.
So we have an Asian liquidity crisis, an underwater corporate whale, and a government blinding itself. It feels like the walls are closing in.
Let's hit topic C before we move on, infrastructure. Volatility brings out the builders and the predators. What's new?
We have a perfect example of both. On the shadow, predatory side, we saw the launch of BEX yesterday.
BEX. Even the name sounds like a dare.
It's aggressive. It's a no KYC, 100 times leverage platform. They launched it explicitly to target retail traders right after the crash. It is predatory timing.
Inviting people to catch a falling knife with massive leverage. Come win your losses back.
Exactly. But on the flip side, the regulated side, you have Tether pivoting onshore. They announced US HAT,
A new regulated stablecoin.
managed by Anchorage Digital. They've even tapped Bo Hines, a former White House advisor, to lead it.
Interesting. Tether, the poster child for offshore opacity, is moving toward legitimacy.
This is them trying to capture the institutional market. It's a sign that despite the price crash, the infrastructure is still maturing. But right now, honestly, the market cares more about the liquidity crunch.
Fair enough. Okay, so we have the Asian contagion, an underwater whale, a political deadlock. But let's look at the third segment, geopolitics. Because there was one piece of news this morning that was arguably less negative.
You're talking about Rafah,
Yeah.
the Gaza-Egypt border.
Yes.
This is a classic pressure release valve. Over the weekend, with the airstrikes, the fear was that ceasefire talks were dead. We were heading for a regional war.
Which would have sent oil spiking, caused a massive flight to safety.
But this morning, the Rafah crossing did open.
Only for 50 patients, right, not a full reopening.
It's tiny operationally, but symbolically it is huge. It signals the diplomatic framework is still functioning. It prevented a total war panic today. I think Bitcoin would be significantly lower if that crossing had stayed shut.
But wait, if war risk goes down, safe havens should stabilize. Gold didn't stabilize, it crashed. Silver crashed even harder.
And that is the key insight for market psychology right now. Gold was down over 5%. Silver was down over 11%.
11%. That's a bloodbath for a safe haven. That doesn't happen.
It confirms the dash for cash thesis. When you see gold and Bitcoin crashing together, it means investors aren't afraid of inflation right now. They're afraid of insolvency. They're selling everything, the good, the bad, the safe, just to raise US dollars.
It's not that they don't like gold or Bitcoin, it's that they need cash to cover those margin calls from the tech wreck.
Precisely. It's forced selling. And forced selling doesn't care about fundamentals, it just cares about liquidity. And that strengthens the dollar index, the DXY, which is a wrecking ball for everything else.
So where does this leave us? If we have to synthesize this into a regime for the listeners, what are we calling this?
I'd call it defensive capitulation. The market is realizing that the supports we relied on, the 75K level, the quick government fix, the endless bid from Strategy Inc., are all fracturing at the same time.
When we are staring down the barrel of Tuesday.
The next 24 hours hinge entirely on Speaker Johnson. It's binary. If that suspension of the rules vote fails, which looks likely, we are in for a prolonged shutdown.
If that vote fails, where do we go?
If scenario A plays out and the vote fails, the next major support is what traders call Goblin Town. We're looking at $72,000. That's the breakdown point from Q2 last year.
And if that doesn't hold,
We are in a very different world. We'd be looking at a much deeper correction.
before we wrap up, I want to leave the listener with one final provocative thought. We talked about Strategy Inc. being underwater. We talked about them diluting shareholders to raise cash. Here's the question I'm mulling over. What happens if the equity investors revolt before the Bitcoin price recovers? I mean, they're buying Bitcoin at $87,000 while the market is at $74,000. That is an immediate loss of value for every dollar raised.
It's a very dangerous game of chicken.
Exactly. If MSTR stock starts to crash harder than Bitcoin, if we see that decoupling we talked about, it means the infinite money glitch is broken. And if that corporate bid evaporates, who is left to buy the dip?
That is the signal to watch. If MSTR decouples, look out below.
On that cheery note, keep your eyes on the KOSPI tonight and the House floor tomorrow. It's going to be a bumpy week. Thanks for diving in with us.
Stay safe out there.